Welcome to this explainer. Today, we're going on a full-blown macroeconomic detective mission. Literally, we are setting out to audit an entire economy. We'll be diving into the incredible challenge of measuring national income, specifically focusing on the expenditure and income methods, and we're going to uncover the very real, practical traps that economists face every single year.
Here's our roadmap for today's audit. We'll start with tracking the macroeconomy, then we'll jump into the giant house audit, tackle the double counting trap, look at inventories and wear and tear, learn how to avoid income audit traps, and finally, we'll wrap up with the ultimate macro payoff. Let's get into it.
Section 1. Tracking the macroeconomy, the triple identity.
Okay, before we look at the massive headaches of measuring an economy, we really have to understand our core objective. What exactly is national income, and how do we even begin to track it? Well, we rely on what we call the triple identity. Notice the three distinct paths here. You've got the product track, the factor income track, and the final expenditure track. The golden rule you need to remember is that national product equals income generated, which equals total expenditure. Basically, every time something is produced, income is generated for someone, and that income is eventually spent. It's this continuous, looping cycle. Today, we're going to look really closely at the specific hurdles on the expenditure and income tracks.
Section 2. The giant house audit, tracking the spending.
So, measuring that expenditure track? Yeah, that is much easier said than done. To really wrap our heads around the difficulties, I want you to step into the role of a lead auditor. Imagine trying to audit every single item bought in a giant family house over a year. You have to track every single rupee spent by every single person under that roof. It sounds like the ultimate household receipt tracking nightmare, right? Well, that's exactly what the expenditure method is, just on a national scale. And as you'll see, adding up everyone's spending gets messy fast.
Section 3. The double counting trap, final versus intermediate.
Let's move on and see how this builds. In our giant house, let's say someone brings home a bag of flour. Do we count it in our final audit? Well, the textbook rule tells us it's actually incredibly hard to draw a strict line between intermediate and final expenditure. Why? Because it depends entirely on the end user. Did they buy that flour to bake a cake for themselves to eat? If so, that's final consumption, and we count it. But what if they bought it to run a small home bakery business? Then it's an intermediate input. If we count the flour when it's bought, and then count the final loaf of bread when it's sold, we've fallen right into the double counting trap. We literally only want to count final goods.
Section 4. Inventories and wear and tear, the basement problem.
Now let's take our audit down into the metaphorical basement of our giant house to tackle our next set of hurdles: unsold goods and broken down appliances. Down in the basement, we find boxes of unsold goods that our family businesses produced but, just didn't manage to sell this year. These unsold goods actually add to our inventory investment, and we absolutely have to include them because they reflect current production. But here is the massive headache. Estimating the exact market value of these inventory changes is chaotic. Without precise price tracking, it's a nightmare because prices fluctuate rapidly over the accounting year. Do we value that inventory at the price it was in January or the price it is in December?
And then we look over at the family oven. It's been heavily used, it's wearing out. In macroeconomics, we call this capital consumption or depreciation. We have to deduct this wear and tear to get an accurate net value of our economy. But economists struggle with exactly how to calculate this. Do we use the historical cost, which is the original price the family paid for the oven 5 years ago? Or do we use the replacement cost, meaning what it would cost at current market prices to buy a new one today? There isn't always a perfect answer here, which makes our job as auditors pretty tough.
Which brings us to perhaps the most frustrating part of auditing this giant house. Think about all the informal trades happening. What happens to our audit when family members in the unorganized sector just don't keep their daily receipts?
This is a massive issue, particularly in underdeveloped or informal sectors. Without precise receipt logs, things get incredibly messy. There is a sheer lack of adequate and reliable data from subsistence and unincorporated sectors. When people aren't logging their daily expenditures, our national data collection becomes totally incomplete. We end up having to rely on estimates, and let's be real, estimates are never as perfectly accurate as actual hard data.
Section 5. Avoiding income audit traps. What not to count.
So, we've seen how tough tracking spending is. Now let's flip the coin from the expenditure method over to the income method. We need to screen what counts as real income for our giant house and what's essentially an illusion. Now, What's really interesting about this slide is how clearly we can divide our world into two distinct categories. On the left, we have our productive factor incomes. These are things like employee compensation, operating surplus like rent and profit, and mixed incomes from self-employed folks. We absolutely count these. But on the right, in red, we have the audit traps. These are flows of money that we must ruthlessly exclude from our national income calculation.
Let's rapid fire through these mandatory exclusions so you don't get tricked on an exam. First, we exclude transfer incomes like old age pensions, unemployment relief, and student scholarships. Why? Simply because no current productive services are rendered in exchange for them this year. We also exclude illegal incomes from smuggling or gambling because, well, they're unaccountable. We exclude windfall gains like lottery winnings. We exclude interest on the national debt, assuming government borrowings just went to consumption. We exclude the sale of secondhand goods because they don't add anything to the current year's flow of new goods. And finally, we exclude private transfers, like the pocket money you get from your parents. Think about it, that's just money moving from one pocket in our giant house to another.
But hey, just because cash didn't physically change hands doesn't mean value wasn't generated. As auditors, we must include the value of goods produced for self-consumption, like a farmer eating their own crops. We also absolutely must include imputed rent for self-occupied houses. Even if you own your house outright and don't pay rent, you're still consuming housing services every single day. We have to estimate that market value and add it in. Otherwise, our final national income number would be way, way too low.
Section 6. The ultimate macro payoff. Why we audit. So, the crucial point is, why do we put ourselves through this? Why deal with missing receipts, confusing inventory valuations, and all these highly specific inclusion and exclusion rules? We do it because of this massive macro payoff. Look, despite all the practical hurdles and the messy data, the expenditure method is absolutely vital. It gives us the precise breakdown of the entire economy. It reveals exactly how much is going into private final consumption expenditure, RC. It shows us the gross domestic capital formation, which is our investments, or I. It breaks down government final spending, G, and our external global balances, net exports, or X minus M. This whole formula, C plus I plus G plus X minus M, it essentially gives policymakers the dashboard they need to steer the entire country's economy.
So, as we wrap up this explainer, I want to leave you with a thought about your own place in this giant family house. Think about the purchases you actually made this week. Did you ask for a receipt? Did you buy something secondhand? If you were audited today, right now, how accurately would your own daily spending be captured in the national data? It really makes you appreciate the incredible detective work that goes into measuring a nation's income, doesn't it? Thanks for joining me on this audit today, and keep tracking those rupees.